Okay, well, good afternoon, and thank you for attending today. This is the first part in our philanthropy educational tract. My name is James Lyons, and I'm a senior financial consultant and partner at Senecal Lyons and Associates Private Wealth Management. We are a family office that provides comprehensive and complete financial planning services to successful business owners and professionals, as well as high net worth families with complex financial planning requirements. The Philanthropy Educational Series is designed to provide timely and important insights to help high net worth families understand and plan ways to implement their desire to give back to society or create a long lasting legacy. The first installment in the series and today's presentation aims to highlight important aspects of gift planning with the aim of leveraging government support through tax credits and deductions. So a couple of notes before we get the presentation started today. Our presentations are live and interactive, so if you do have questions, we encourage you to use the Q&A function on your screen. We'll get to as many questions as we can before the end of the presentation. If we can't get to yours, we will follow up after with the response and share any offline questions that come in if they are of general nature. One thing I would ask is that if you do have a question that's specific to your personal circumstances, please reach out and we'd be happy to address that independently. Finally, the contents of today's presentation are meant to be conceptual in nature and should not be taken as specific advice. Any of the strategies outlined today would need to be considered in the context of your individual circumstances and may or may not apply based on your situation. So for just a moment here before we get into the presentation, just wanted to spend a quick second to talk about how legacy planning and sharing your wealth fits into a financial plan as a whole, and our process for working through financial plans here. So legacy and gift planning is a very specific component of a financial plan, but is not a plan in and of itself. The concept of, saying I want to give X to charity or leave Y to my family upon my ultimate passing is a really nice sentiment, but of course isn't a plan in general. And if I were to use the example of, let's say your retirement hasn't been tested sufficiently to account for variables, account for changes in your life throughout your working career and your retirement, there might not actually be enough left in your estate to, follow through with your charitable goals and meet your charitable pursuits. What if your investment return is not what you expect? What if inflation is higher than forecasted throughout your lifetime? What if you get sick and can't work? Of course, that'll have an impact on your ability to fund your charitable initiatives. So when we work through a financial plan, one of our core principles as a family office is that financial planning should be comprehensive and consider the various relevant factors of your financial plan in conjunction with each other, whether that's managing cash flow of your business, preparing for unexpected events, death, disability, increase in prices, all of those types of things. We work with our clients to ensure that first and foremost, we understand how each factor impacts the other factors to ensure a cohesive plan that creates certainty in all areas of their financial future. What further distinguishes our family office is the inclusion of all family members in the planning process, often providing financial information to our clients' parents and children and preparing financial plans for their benefit. So with that in mind, we'll take a quick second to talk about the presentation today. So here's some of the topics that we will be covering. We'll be discussing the reasons for giving and how to receive tax benefits. We will then illustrate a few of those concepts with ideas in the form of a case study. Every one of these sections could easily be the subject of an in-depth presentation, so this will be a brief overview of a lot of the concepts. And if you are interested in learning more, there will be future presentations that go into the nuances of different concepts. And if you have specific questions, again, please reach out and get in touch here. So without further ado, presenting the first installment of our series today is Pierre Senecal, who's an executive financial consultant and senior partner at Senecal Lyons and Associates. Pierre has decades of experience as a business owner in the fields of manufacturing, land development, construction, international trade, and finance. Pierre specializes in providing advice on financial, tax, and estate matters to our clients. In addition to being a CPA, Pierre holds many industry-leading designations, including the very relevant Certified Financial Planner, Trust and Estate Practitioner, and Chartered Life Underwriter, making him one of the top financial planners in the industry. Pierre is also recognized as a Master Financial Planner in Philanthropy and a member of the Canadian Association of Gift Planners. So welcome, Pierre. Thanks for joining the presentation today. And without further ado, I'll let you take it away.
Thank you, James. Good afternoon, everyone, and thanks for tuning in. To start, many people think that charitable giving is about saving money. Rather, I think that philanthropy is about wanting to give back or creating a legacy, a lot more than just saving money. Giving to charitable organizations will save you income tax, but never to the extent that you give. So first disclaimer here, there's still part of the donation that comes out of your pocket at some point. So successful business owners and professionals and high net worth families most often don't give, like I said, for financial reasons or tax-related reasons. The reasons differ, but at the end of the day, it's all about giving back and supporting your community. So it is all about caring. There was a survey in 2018 by Cardinal Capital Management that asked a lot of high net worth people, and just ordinary donors, why they gave to Canadian charities. Their overall conclusion was that most people do not give because of the tax savings, but because they care about a cause and want to help others. Another interesting conclusion of that is that most people, even the wealthiest amongst us, do not have a plan to give. At least, at best, they're reactive. So there is a lot of opportunity here to do a bit more planning and save a lot more money. So who can you give to? There's a difference between a nonprofit organization and a registered charity. They might have similar goals, and in most cases, nonprofits and registered charities are not subject to taxation on their organization's income. But at the end of the day, only registered charities could issue receipts that will give you a donation tax credit. We heard a lot about the GoFundMe pages lately, and they've become very popular in the last years. However, they make a lot of money for the people who actually run the page, but donations that go through a GoFundMe page do not qualify for the donation tax credit. In those cases, if you can, better to give directly to the beneficiary, or maybe if you can through a registered charity and get a receipt for that. So let's jump into the whole idea of taxation and tax savings as you give. Like I said earlier, you don't save as much in taxes as you give away, but you can think of tax saving as leveraging your gift and maybe encouraging you to give a bit more than you would have otherwise, because the government's going to subsidize part of it. As we'll discuss in further detail, there are several advantages to planning carefully in order to maximize the benefits of charitable giving. Especially when it comes to tax efficiency, thinking long-term about the implications for your overall estate's tax liability, for example, or your family's well-being. So you need to evaluate when to donate, what to donate, and how to donate. So let's start with some background on tax implication. The federal and provincial governments have supported the whole objective of increasing gifts and bequests by implementing tax breaks and legislation designed to help and encourage us to actually give a bit more than we would have otherwise. These incentives make planned gifts even more attractive to potential donors. So for individuals, we get a tax credit. In Ontario, for example, the amount of charitable donation you can claim in a given year is 75% of your net income. You cannot get a tax break for more than that amount. But you can additionally save some taxes on capital gains for in-kind donations. And we'll talk about that a bit later. And if you happen to give more than 75% of your income in a given year, well, you can carry forward any unused portion for up to 5 years. If the gift is made at death through your will or by other means, and if the gift is received by the charity within the first 60 months after you die, This limit is increased to 100% from 75 of your net income in the year of your death. And you can also top up to 100% of your net income in the year immediately preceding the year of your death. And again, the executor has the flexibility to apply any portion of the donation receipt to an income tax return of the estate, subject to a 5-year carry forward rule, which basically means if you don't use your donation this year, you can use it in any of the next 5 years. Calculation of the tax credit, it's not really straightforward. The first $200 of donation a year, you get a minimum tax credit of, in Ontario, 20.05%, which means that on your first $200, you would get about $40 back. However, in Ontario, again, anything over $200 in a given year will attract anywhere between 40 and 48% tax refund. Again, depending on your taxable income, the higher your income, the higher your refund. Corporations, on the other hand, don't get a tax credit. They actually get a deductions from their income on their taxable income. Again, limited to 75% of its taxable income, and you can carry forward any unused portion for up to 5 years. And if you give securities in kind, you avoid paying taxes on any capital gains. So this capital gain on the in-kind gift could be 100% subject to a tax-free capital gain. So if you have shares worth 100,000 and they cost you 20,000, you have 80,000 of capital gains if you give it away, and that 80,000 could be subject to a tax-free dividend to one of the shareholders. We'll dig deeper into this strategy in our second installment of this educational tract. For many Canadians, leveraging their ability to support their causes requires a bit of thought and planning. You know, you've worked hard to get where you are today, and you may be thinking about the best approach to share your wealth because you are a giving person. And although giving to charity should be planned like all your other finances to get the most out of your giving. A carefully constructed giving plan helps create legacy of giving that expresses your values and cares. You know, you don't have to wait to donate until death. Instead, you can give during your lifetime to maximize tax benefits so your giving already begins to have an impact on others. Making charitable decisions now could also kickstart discussions for your family about how the money will be transferred between generations. You know, your children can sit on the boards of a private foundation or donor advised funds. We'll get back to that a bit later. And they can be involved in discussions about what causes you all want to support. So there are many ways, many options when it comes to giving to charity. We'll go through the simpler ones in this webinar and then discuss the more advanced and complex strategies in our second installment later on this year. You know, you can donate cash, donate through your will, you can donate in kind. We talked about that a bit. You can buy and donate flow-through shares or life insurance policies. They're more complex and specialized donation strategies that we will discuss in our second installment also. You can donate your RSPs, RIF, TFSAs at death or before. And you can establish a charitable foundation or donor advised fund. So we'll get into them a bit separately right now. Donating cash, the easiest and quickest way to give to charities. That's how most people do give. Doesn't really require any planning or thought, but you should just remember to collect your charitable receipts for tax time. CRA has no way of tracking that, so if you don't have them, you can't deduct them. A simple option is to leave a bequest in your will. You know, I want to leave $10,000 to this charity or a percentage of my estate. But it could be money, could be an in-kind gift also, could be artwork, could be securities or real estate. And you can give the charity when you make that gift at death, the freedom to use it as you see, or rather as they see fit, or you can direct the gift towards a specific activity. But you want to check with the charity beforehand to ensure that this is acceptable to them. You know, a charity has the right to decline a gift if they want or if they can't handle it. That could throw a wrench in your estate's tax plan if that's the case. With a bequest in your will or specific gift, your estate will receive a charitable donation tax receipt. And if well planned, this tax receipt could eliminate all the income tax on your final tax return and possibly on the return for the year immediately preceding your death. However, the value of the tax reduction would be far less than the value of the gift. It's important you be aware the gift will reduce the residue of your estate that is available for your heirs. If that's not your intent, don't cause your estate to make a gift to charity. Selling securities, let's talk about donating in kind here. Selling of securities, stocks, bonds, or whatever in order to raise cash to make a charitable gift can trigger a capital gain and resulting of a percentage of the gain being included in your income. However, since 2006, the Income Tax Act provides that donating a publicly listed security directly to a registered charity is more tax advantageous since you don't have to pay tax on any portion of the resulting capital gains on a direct in-kind donations. That is, the inclusion rate, instead of being 50%, would be 0%. When receiving your gift in kind, the charity issues a tax receipt for the fair market value of the investment. So publicly listed securities include stock, bonds, mutual funds, ETFs, segregated funds also. If you own a RSP, a RIF, or a TFSA and designate a charity directly or indirectly as the beneficiary of your registered accounts, your RSP, your RIF, or TFSA, charity will be able to issue a donation receipt for the funds it receives. That could be a strategy to reduce the tax bite of deregistering your RIF or RSPs at death. You can name your estate as the beneficiary of the plan and make the bequest to the charity or make the make the charity give them a bequest in your will, or you can name the charity directly with the plan issuer, with the insurance company or your stockbroker as the beneficiary. In both cases, it's very important to record the proper legal name of the charity because, at the end of the day, many charities have similar names, and we've had situations where they wanted to give to one specific charity, but there was one like that in every city. So it does cause confusion. And in some cases, they just had the wrong name and we couldn't go through with it. Either way, the donation receipt is issued based on the fair market value of the assets donated. Again, the executor has the flexibility to use all or a portion of the receipted donations when filling terminal or estate tax returns. There are many tax and estate planning issues to consider before electing to name a charity as beneficiary through your will or directly. It's best to sit down with a financial advisor to discuss all of the implications before you proceed. Buying and donating flow-through shares is a complex and specialized donation strategy, typically aimed at individuals who are very high net worth and earn an annual taxable income north of $500,000, for example. Under the strategy, donors could end up getting up to 90% of their charitable contribution back in the form of income tax benefits. We'll discuss this and show examples in our second installment of this series. Donating through life insurance gives the potential to donate much more than the dollars you actually put into it. There are several strategies available depending on your goals. And again, this will be looked at through in our next session. A private foundation does more than ensure your generosity will live on. It can also permanently associate your name or your family's name with the causes you've chosen. Private foundation has significant legal setup costs and annual administration fees and reporting. And then again, once you pass away, you'll need to decide who will continue as directors of the private foundation. You always got to wonder if those who will carry on the private foundation have the same enthusiasm for the purpose of the foundation. Usually they're funded by a substantial gift you make during your lifetime or upon death. A foundation is a way to provide your favorite charities with regular income to fund their activities, or perhaps, for example, to provide scholarships to deserving students. The rules for registering a private foundation are quite complex, and a private foundation requires considerable administration, which can be very expensive and time-consuming. As an alternative to private foundations, a donor-advised fund operates in pretty much similar way, but without the high startup cost or administrative costs. Because foundations are expensive, like we said, more and more Canadians, even high net worth families, are turning to donor advised funds as a great alternative to leave a long-term legacy. So what's a donor advised fund? It's similar to a private foundation in that, just like the charitable foundation, when you give, the full contribution to that fund, or to the foundation in the other case, provides a charitable donation receipt in the year the donation to the fund, not in the year that the fund gives money to charities. Anybody could donate to the fund, even if it's yours, although there are usually annual minimums and donations of a few $100s to do so. Just like for a foundation, the client who initiates the account, or their families or successors, decide annually which charity will benefit from a portion of their invested funds. And for a small fee, the cumbersome reporting and time-consuming regulatory compliance is handled by the fund administrators, so the donors are totally free from those burdens. It's that easy. Many high net worth and successful business owners use a selection of annual recipients as a way to get their kids and their families involved and aware of giving back. They like the educational value for their kids, and it often, we find, helps maintain family harmony in sometimes even difficult times. For business owners, donor advised funds avoid tax complications arising from the ownership of both a private foundation and a private corporation. Won't get into that, but it is a definite avenue, if you are a business owner, that you should consider rather than the foundation. Many of our clients have set up and named their own donor advised fund through the IG Strategic Charitable Giving Fund. We currently manage just under $800,000 in donor advised funds, giving about $40,000 per year to local charities. Our 5-year goal is to manage $10 million in charitable funds and providing $500,000 per year from our family clients to their favorite charities. We have set up, for example, the Senecal Lions Charitable Giving Fund a few years back, and every year as a team and in discussion with clients, we give to local charities. Now let's put this all together. Kieran Leva is a senior financial consultant with Senecal Lions and Associates. He holds both the Certified Financial Planner and Registered Retirement Consultant designations. Kieran will present a few case studies representing composites of real-life situations. Take it away, Kieran.
All right, thanks, Pierre, and good afternoon, everybody. Let's go through some case studies. So our first case study here is Joyce. So Joyce is a 55-year-old doctor. She lives and practices in Ontario, and she earns a healthy income of $250,000 per year. Joyce has been a diligent saver and investor over the years, and she's been able to amass a portfolio of $6 million. So Joyce doesn't have a spouse. She has no children of her own, but she has nieces and nephews whom she cares and loves for a lot. So Joyce's estate objectives are to leave half of her portfolio to charity and half to her nieces and nephews. One second. So what could happen? So if Joyce passes away, her executor will follow through with her wishes and give half to her nieces and nephews and half to her favorite charities. So as Pierre mentioned earlier, in a normal year, you can claim up to 75% of your income as a charitable donation. But in the year of your death and the year prior, you can claim 100% of your income through charitable donations. So let's say in Joyce's situation, in the year of her death, she has about $500,000 of income through RIFs, capital gains, or other forms of income. And the income in the year prior to death is $250,000, which we've outlined earlier. So the executor would be able to claim $750,000 of the charitable donations on her tax return for the year of death and the year prior. This would save about $375,000 in tax. So the issue here is that $3 million has gone to charity, but $2.25 million worth of charitable donations doesn't really offer Joyce or her estate any tax savings at all. So what could Joyce have done? So what Joyce could have done was set up a charitable foundation or a donor advised fund. So by donating $187,500 while alive, which is about 75% of her net income of $250,000, she would be able to save about $93,750 per year in tax during her lifetime. And this is assuming provincial and federal donation tax credits of 50%. So in Joyce's situation, giving up $2.25 million in charitable credits is to give up at least $1 million in tax savings. And this is what was done in the first example, where it was all donated upon her passing. So donating through her lifetime can reduce or eliminate potential missed tax savings. Is there another way? So as Pierre has alluded to, in our second installment, we'll be going over some additional philanthropic strategies, and we'll explain a unique strategy which we created for a few of our higher net worth clients who are in a similar situation to Joyce. And the end results were that the family and their downline were able to reduce their income tax for years following their death. So what else can we consider? So like most doctors and physicians, Joyce has a corporation. So would it make sense to donate through her corporation as opposed to her personal situation? So the answer to that depends. Like many things in financial planning, we would essentially need to review both her individual and corporate tax situation in order to kind of identify what the potential gift sources would be to maximize things from a tax perspective. So in Joyce's situation, it was her preference to use the excess funds within her corporation to fund business activities and growth. Her corporation is able to take advantage of tax deferral opportunities by keeping the funds within the corporation. Additionally, her corporation is taxed at the small business rate, which limits the value of the charitable deduction. Essentially, the more tax that you pay, the more benefit you can get from charitable donations. So looking at Joyce's personal situation and the marginal tax rate that she's in, we're able to deduct a higher amount because she's paying more tax on the personal side of things versus the corporate side of things. Additionally, in Joyce's individual investments in a non-registered portfolio, if she has positions that have substantial capital gains, she'd be able to donate those in kind and eliminate the taxable capital gain. All right, let's look at another situation. So let's take a look at Wendy. So Wendy's a 65-year-old widow. She's got a couple kids and a few grandchildren, and she already has a charitable mindset. She's already giving about $15,000 a year to charity. Now, Wendy has a healthy income of $160,000, but she lives a modest lifestyle. She only needs $50,000 a year to live her desired lifestyle. So within Wendy's financial situation, she has one stock that's essentially a home run. She bought it for $50,000, and over the years, it's grown to $300,000. So in sitting with her advisor advised her that she has some concentration risk here. Too much of her net worth is tied up in this single stock. And the advisor advised her to essentially rebalance her situation. And in this case, their plan is to exit the position altogether. So for planning purposes, we're going to assume that Wendy has a life expectancy of age 85, so another 20 years. So over the next 20 years, Wendy kind of continues with what she's been doing, and she continues to contribute $15,000 a year for a total of $300,000. So in each one of these years, the $15,000 annual donation generates about $6,900 in tax credits per year. So this is based on a 46% donation tax credit rate for $6,900. So if we extrapolate that over 20 years, the total tax savings would be $138,000. Unfortunately for Wendy, the charity and the cause that she's passionate about doesn't accept in-kind donations, as we kind of discussed earlier in the presentation. So given the large income inclusion for the portfolio rebalance and essentially selling out of this position, we're going to assume that Wendy's marginal tax rate is 50%. So as we discussed earlier, she bought the stock for $50,000. She sold it for $300,000, which means there's a capital gain of $250,000. Half of your capital gains are tax-free, so that leaves $125,000 to be taxed at 50%, which results in a taxable capital gain of $62,500. So when we look at the tax savings over the 20 years and the tax consequences of selling this position, if we take $138,000 from the total tax credits from the donations and subtract the $62,500 from the taxable capital gain, she has net tax savings from these transactions of $75,500. Next slide, please. So what could she have done differently? So if instead of donating over a period of the 20 years as we discussed, Wendy could have considered donating $300,000 to a donor advised fund in kind. And this would be the stock that she had that had those sizable capital gains. This would immediately save $62,500 in tax by donating it in kind. So these tax credits can be used over a period of 5 years. And if we do that effectively, we'll be able to save $27,600 each year, which totals the same $138,000. But of course, omitting the capital gain. So from the donor advised fund, what Wendy could do is donate about 5% of this total towards the fund and the charity that she's passionate about. So she's still able to contribute at regular amounts while also getting the benefits of transferring that in kind. Additionally, if Wendy does become incapable or if she passes away, she can give the authority over this donor advised fund to her children or grandchildren, involving them in the charitable giving process going forward. So to kind of wrap things up here, there's obviously a lot of benefits to giving to a charitable cause from a tax standpoint, but as Pierre touched on early on in the presentation, most people are donating because there's causes or communities that they support or would like to give back to. So by giving to charities, you can reduce your income tax liability over your lifetime or from your estate. Giving any positions that have capital gains in a non-registered account directly into a charitable foundation or donor advised fund can reduce or eliminate entirely the taxable capital gain on that position. So as we can see, everybody's situation is different. So you should be speaking to a professional to devise the best strategy to give back if it's something that you're looking to do. So with that being said, I'm going to hand it back over to James, and he's going to close out the presentation.
Yes, thank you, Kieran. Appreciate all of your insights and that wealth of knowledge you shared with us today. I'm just going to share a friendly reminder here that if anybody does have a question that they would like to be addressed, the Q&A function is open. We're just working through it to gather all the questions here. If I may, I'm just going to take a moment here to introduce our team and talk about how we work with our clients. So you see on the board there, we've got Pierre, Kieran, and the rest of our client servicing team available. So again, we are a family office that provides comprehensive and complete financial planning services to successful business owners, professionals, as well as high net worth families with complex financial planning requirements. Could I get the slide forward, please? When we work with our clients, you'll see a bit of our process outline here. We like to integrate ourselves into the client's already existing financial framework, whether or not that's working with an accountant, lawyer, some type of personal advisor, whatever the case is. We're not trying to replace already trusted and existing relationships. Rather, as we work with our clients, we're looking to be added to their financial team and work alongside their already trusted professionals, bring our expertise as well as our in-house specialists. When you work with Seneca Lyons and Associates and retain our services, you are not simply gaining access to our team, our credentials, our qualifications, and our services, but also the in-house specialists provided through IG Private Wealth Management and IG's preferred partners, who, if we go to our next slide here, if you could go a couple forward, Pierre. So IG is actually about to celebrate its centennial anniversary. IG has been a Canadian-owned and operated company since 1926. There's over 2,000 advisory teams servicing clients across the country, and IG has a proprietary tool that we utilize called the Living Plan, which is a tool that we utilize with our clients to design and implement financial plans that consider all the pertinent financial factors. And one of the beauties of our program is that we can utilize it to not only create a database and a financial plan, but to also test various financial planning strategies and see how effective they are at achieving your goals. When I spoke earlier about hiring Seneca Lyons and Associates and getting access to the, I guess, the Power Financial Corporation, you'll see here that IG Wealth Management is under the Power Corporation of Canada umbrella. You'll see our sister companies there, Wealthsimple, Mackenzie, Putnam, Canada Life, all large Canadian companies in the financial services space here. And how we've structured things is that IG has gone out into the market and partnered with leading companies in their specific spaces and brought them onto our team to provide services, whether that's in the investment management space with Rockefeller, BlackRock, Buell Goodman, T. Rowe Price, to name a few. In the insurance space, you'll see the biggest insurers in the country are there, and as well as banking, mortgages, lines of credit, all of those types of things. IG has gone out into the marketplace and partnered with the biggest investors in the industry to ensure that we not only have the advice and services for our clients, but also have the products to suit their needs. If I could get a slide forward here. We talked quite a bit about legacy planning and gift planning here. IG as a company, as well as Seneca Lyons and Associates, have made charitable giving and philanthropy a big part of our initiative here. So every dollar that comes into the company, a few cents goes towards charitable initiatives through the corporation. But as Pierre mentioned earlier, for the last 5 years, we've been running our own charitable giving fund, which each year gives to more local charities and not necessarily national charities. If I get the slide forward, please, here. So just give me a moment to go through the questions. Pierre, I'll ask you to come back on for a moment here. Okay, so Pierre, you had mentioned, I'll just give a little bit of context here before we get to the question. So one of the parts that you had mentioned throughout the presentation was that the donor advised fund avoids some of the administrative costs of setting up a charitable foundation. The question is, how much does it cost to set up and run a donor advised fund with IG?
Okay, well, the IG Strategic Charitable Giving Fund, that's the name of our program, has no upfront cost whatsoever. So if you put money into the foundation, that is the money that is going to work for you to help your charity. So there's no upfront cost to set, there's no lawyer fee, there's nothing, as you would have in a foundation. And on an annual basis, I mean, you're investing the money, so you have any management fees that you would have in any investments, MERs for mutual funds, for example. But the cost over and above that, the cost to the foundation is 0.55% a year. So just over 0.5% of the assets in there a year as a cost. So for example, if you have a $10,000 donor advised fund, it's costing the fund $55, not out of your pocket, by the way, but out of the fund, the funds you've invested out of the profits in that year, $55. If you have 100,000, it's $550 a year, a lot less than the fees you would have paid to set up a foundation. Again, those fees are not paid by you, or you don't get a bill. They're taken from the funds themselves and typically out of the profits from the investments.
Excellent. Thank you, Pierre. And in that light, another question interestingly came in about the donor advised fund here. So I'll just share that. And I think you mentioned the amount 10,000 there as part of your explanation, but is there a minimum donation amount to start the donor advised fund?
Yes, there is. The donor advised funds has to be initiated with a $10,000 contribution minimum. That's to start it off. After that, any additional contribution is a minimum $500. By the way, you don't have to be, the one who gives those additional or those initial contributions or tax, charitable gifts. Anybody could add money to the fund, and we did have over the years a few clients who decided to help us out here and added money to our fund, to our charitable fund. So every additional after you start is $500 to get that charitable receipt.
Excellent. And then another question about the donor advised fund here. It seems to be a popular topic from today's discussion. Could I choose the name of my foundation?
This makes me realize maybe one of our next sessions will be on donor advised funds only. But, within reason, you can pretty much choose the name you want for your donor advised funds. I mean, you can't call it a foundation because it's not a foundation. It's a donor advised fund. But, you can call it the, Smith Family Charitable Giving Fund or whatever you want to call it. And you can, put that name there. So a lot of flexibility in that name, just a few guidelines you have to follow.
Excellent. Thanks for that, Pierre. So that's going to be the end of our questions here. Could I just get you to slide forward here? I just wanted to share with the attendees today that we are doing these presentations about every 6 weeks or so. We cover a variety of subjects that are relevant in financial planning. We find are relevant to our clients and to their families and the people that they care about. So you'll see that our next one is coming up in a couple of months here for May. Please note that if you did find value in today's presentation, we will be diving a little bit deeper into concepts related to philanthropy on September 3rd. So please mark that in your calendars that will be occurring later this year. And as Pierre mentioned, we'll be touching on some more specific strategies like flow through shares, donation of life insurance policies, and other more nuanced strategies here. And if you see any other subjects there that are of interest to you, the registration links for our webinars are available through our website, which you will see at the bottom here. A couple of other quick thoughts here. You'll note there that we are posting all of our webinars to the website. So if there's a tidbit today that you didn't get to take a note on or what have you, the presentations are available on our website on demand. Finally, if there was a question that you did have that didn't get addressed today, either specific to your circumstances or maybe you think about it after, please feel to reach out to us through our corporate email. There you'll see senecal.lyons@igpwm, and we'll be happy to get in touch and address any questions that you do have. So with that, we will conclude the presentation. Pierre, Kieran, thank you for the wealth of knowledge and insight that you shared today. Thank you to all of the attendees, and have a great rest of the day.
Thank you all.